Hey, what's going on, guys? My name is Cody Charnell. I'm a multifamily real estate broker here in Long Beach. And today we're going to be looking at this 7-unit value add deal here in Long Beach. Before we get into it, a big thanks to John Alden with Step Commercial. John's the listing agent on this property and allowed me to bring it to you. So big thanks to John. And without further ado, let's get into it. Okay, so let's start with location. The property address is 1201 Ohio. It's located in the Zafaria neighborhood, which you can see outlined here. So basically, it goes from 10th Street all the way over to Loma, up to PCH, and down Wanapero. So a lot of people will talk about the design district kind of synonymously with Zafaria. So within this neighborhood, there's a couple streets, Coronado being one of them, which has Urban Americana. It's an antique store. They have some cool coffee shops, cool design companies. Over here on Obispo, there's Roland Sands Design, which is like a motorcycle design company. Kind of everything design related seems to be clustered kind of right in this commercial area. Property is located within Zafaria, but it's also bordering some other interesting neighborhoods. So to the south, when you go just south of 10th Street, you're in Rose Park, which is a historic neighborhood that has lots of cool craftsmen, Spanish style homes, very kind of trendy neighborhood. South of that is Rose Park South, which kind of butts up to Retro Road down here on 4th Street. So overall, not a bad location. Okay, so let's now look at some property details. Okay, so here's a little bit more about this property. It's 1963 construction. Like I mentioned, 7 units. And all 7 of the units are 2-bed, 1-bath. The total square footage of the building is 6604, which if you divide by 7 means that the average unit is roughly 943 square feet. You also have 4 garages at the back. This is a tight neighborhood for parking, so you can rent those for additional rent, or you have the potential for converting those into ADUs. So if you're converting existing garage space within a multifamily property, you can do up to 25% of the unit count. So this property is 7 units. So you're not quite there to get 2 ADUs, but you can definitely do 1. So you can see some of the interiors of the units. There are a couple vacancies at the property, which is really nice for a new investor coming in because you have the option to renovate and raise rents up to market price. So these are good sized 2-bed units, and fully renovated, you should be able to get about 2,100 per unit. So here we can see the unit mix and rents. So we were able to get into one of the vacancies, as you can see here. The unit's not in terrible condition. It could be rented as is. An investor would get significantly more rent if they were to renovate and make this one look a bit nicer. So stuff like updating the kitchen, updating the bathroom, maybe doing vinyl plank throughout the unit, and then just doing some basic touch-up paint. I think that's all this would need to get market rent. So like I mentioned before, market rent for a large 2-bed, 1-bath in this neighborhood is about 2,100. So I think that more than makes up for the cost of renovating it. It's going to add to your equity in the property, and it's going to significantly increase the overall value of the building if you're getting 2,100 per unit. Okay, so now let's talk about the numbers. Okay, so here's my pro forma for the property. As you can see, asking price is $2 million. The unit mix and rent is down here. So in this column, we have current rents. The 2 that are at 2,100 are the vacant units. So those ones haven't been rented out yet, but we're just using market rent as a placeholder. And then you can see over here, 2,100 is market rent for all of these 2-bed units. For financing up here, we have a down payment of $955,000. Because this property is over 5 units, the commercial lender is going to qualify this loan a bit differently than if you were getting a loan for like a 2 to 4 unit property. So interest rates are a little bit lower than residential rates. So you're looking at probably around 5.8%. But this is really the metric that they care about. They want to see that the property can hit a 1.2 debt coverage ratio before they'll lend to you. So they're going to make you put enough down so that the property is cash flowing from day one. I forgot to mention down here, we have the 4 garages, which I'm including rent for those of $100 a month. There is also a laundry room on site. I didn't have any extra income in the pro forma for that, but If you were to put in coin operated machines, you could probably generate $50 or more per month from the laundry room. All right, so if we come now over to our summary tab, we can see how the numbers sort of shake out. So based on the current income, you'd be buying this property at about 13.8 times gross, which is not terrible because there is upside on the property. Once rents are all the way up at market price, this building would operate at about 11 times gross. So if you've watched a lot of these videos, I tend to always focus on gross rent multiplier. Gross rent multiplier is my favorite metric when analyzing multifamily properties because it takes expenses out of the equation. So it makes the numbers a little bit cleaner. We can estimate expenses pretty well on small multifamily properties when they're individually metered for gas and electricity. So I feel taking those expenses out makes it a little bit easier to compare apples to apples. And gross rent multiplier is really fast to calculate, which is another reason that I like it. So the equation is basically just the price divided by the gross rents that the property produces. So to come up with this 13.88 times gross, you would just divide 2 million by our gross scheduled rent, our current rent, and that gives us 13.8. Another way to think about this is you're paying $13 in purchase price for every $1 of income that the building's generating. So in general, you want the gross rent multiplier to be lower. If we come down here to the cash flow section, so with that $144,000 in gross income, after we take out a vacancy of 3% plus our expenses and our mortgage payments, this property is going to be cash flowing about $14,000 right off the bat. But once we get it up to market rent, that cash flow goes up significantly. So all 7 of the units are going to need some work in order to achieve market rent. So if I was looking to buy this building, I'd want to figure out what's it going to be worth after I put in all that effort. So what this pro forma does is it will calculate our after repair value or our stabilized value based on whatever gross rent multiplier we put in. So basically what this pro forma is saying is we're going to buy this property at 13.8 times gross. Once we raise rents, it'll be operating at 11 times gross. And if we wanted to resell it, we think we could resell it at about 12 and a quarter or 12.25 times gross. At 12.25 times gross, based on this rent, your property value is going to be about 2.2 million. So what you'd have to figure out is if you buy this property for 2 million, renovate 7 units, and then your after repair value is 2.2 million, is there enough of a spread in there to make this investment work? So, okay, so let me know what you think about this property in the comments. If there are any other properties that you'd like me to analyze, I'm trying to put out one of these videos per day, so feel free to send any properties my way. And for all the financial documents that we went through during the video, I'm going to link to those below in the description. All right, well, thanks so much for watching. If you got value out of this video, make sure to like and subscribe. And remember, invest well, trust Cody Charnow.